G'day expats, ladies and gentlemen. Welcome to another episode of Expat Chats. Today is a special episode where I'm joined by our Managing Director for our tax arm, Ben Turner. Good morning, Ben. How are you?
Very well, thanks, James. Thanks for inviting me.
Of course, mate. And I wanted to get you on off the back of the CGT and negative gearing changes from the recent budget, because it is pretty much being legislated around the CGT changes. But there's a bit of a nasty one in there that I wanted to unpack with you today, that will apply to a lot of our clients, a lot of Australian expats, non-residents. And I just wanted to essentially do a quick episode and grill you with some questions and get you to unpack it a bit. Before we jump into today's episode, as always, a bit of a disclaimer. So anything you hear today or witness or see today on the YouTube channel as well should only be treated as general in nature. It is not personal advice. If you do need personal advice, please reach out to a qualified tax accountant, tax lawyer, qualified financial advisor, but only to be used for education purposes only. Now, Ben, let's jump into it. The CGT bill passed last week, and buried in it is a bit of a residency trap that could cost expats their whole indexation benefit. Can you explain what has changed?
Yeah, absolutely. And it was one of the key things I was keeping an eye out because the history of CGT and expats over the last probably 10 to 15 years hasn't been too kind on expats, and it was a bit silent prior throughout the budget cycle as to what was actually happening. So the devil's always in the detail, as we say. So it was interesting to see that legislation actually go through. And a key element of the changes there is just on how harshly this can be for non-residents. Just to recap what the changes are. So effectively from 1st of July 2027, they're basically ditching the CGT discount method for all but very limited assets,
Mm.
and they're moving to an indexation model. So this is going back to what it used to be like in sort of 1999 prior to that, where you effectively take the consumer price index, CPI, the inflation amount,
Mhm.
and this is typically on a quarter by quarter basis, and work out how much the indexation has moved since you purchased the asset, and adjust the cost base for that indexation amount, and that's a replacement for the CGT discount.
Mm.
So the longer you hold an asset, the more of the inflation that will apply to that, and therefore that percentage grows over time. So it's really just an adjustment for the time value of money,
Yep.
um, to put you in the same position as if you had the dollar now compared with the dollar in the future.
Mm.
Um, but but within that, there's a bit of a sleeper in the sense that it specifies in this legislation that if you are a non-resident for one day over the period, and this period is uh, um, the period starting from 1st July 2027, then this indexation method does not apply to you at all. So if you were to hold an asset for 20 years past 1st July 2027 and you were overseas as a non-resident at the time and sort of came back, even if you're only a non-resident for one day over that ownership period, you could be fully excluded from any adjustment under the indexation method.
Mm.
Um, so depending on what the numbers turn out to be, that could be quite a significant implication, or not so much if it was something that didn't change in value or you sold it shortly after 2027 perhaps, but
Mm.
could have, it's got huge potential for downside there.
Yeah, because if we compare this to the old method, the 50% CGT discount method, when when expats or Aussies returned back to Australia, they resumed Australian tax residency. They owned an Australian investment property already, so there's a period of non-residency of ownership and then a period of Australian tax residency of ownership. They used to be able to
Mhm.
tap into the 50% again only for that prorated period. But
Yeah, that's right. And so just to summarize that,
hmm,
there's a few different ways to sort of calculate that, and there was some grandfathering under some existing rules that came in, but just in a very broad terms, the way CGT discount worked for non-residents is you took the ownership period and you split up the amount of days over that ownership period that you're a tax resident versus non-resident. So say you owned an asset for 10 years
Hmm.
and 5 of those you were non-resident and 5 of those you were resident, then you are entitled to half of the 50% discount. So you'd be entitled to 25% discount in that case.
Hmm.
So that's changing completely under the indexation method, and someone who is a non-resident for one day of the ownership period after 1st July 2027 are not able to use the indexation method at all.
Gosh, it just is just so punitive to be an expat and hold these properties. Do you think the government's, I mean, aware of what they've done here accidentally by legislating this, not being able to access it at all, and how it's going to actually impact Australian citizens when they come back to and resume residency? Do you think they're actually aware of this yet?
I don't think they've fully considered it, or if they have kept it pretty quiet.
Hmm.
Um, it isn't something that has been sort of in the news at all. It doesn't seem like it's received much attention anywhere. But perhaps that's because expats, like I've sort of mentioned, seem to have
Mm.
been on the raw end of the stick for these sorts of changes quite regularly.
Yep.
But yeah, I'd be curious to understand the thought process behind the government, because the whole concept of indexation is to try and put somebody just in the same position that they would have been had they sold that asset um, into today's dollars terms.
Hmm.
So,
Hmm.
CPI still applies equally to someone who's a non-resident to a resident. So it seems quite deliberate that you're penalising non-residents there. So effectively, if you hold an asset for 20 years, for instance, and it's a dollar now is only worth half of what it was back in the day, then you're forgoing half of that benefit.
Mm. And I mean, the changes are obviously applying to all investment assets. There was no real specific carve out saying the CGT changes are only applying to residential property. We know how they're laying it up around negative gearing, but I just want to drill down on the CGT with you today. So can you elaborate a little bit then on the concept of deemed disposal and how this might change one's decision on deemed disposal? Because every now and then we have the odd client that
Mhm.
doesn't opt into deemed disposal, or they miss the opportunity because of maybe the big four looking after them and not opting into it, or just their current tax accountant not knowing about deemed disposal because it's not something they do every single day compared to us. But how does this move the decision making around deemed disposal, knowing that indexation is now completely gone for expats?
Yeah, that's a very good point. So there's probably two cohorts that people need to consider. So
Hmm.
Australian investment properties, and that can include your main residence if you come back and you're not treated as fully exempt over the whole time that you own that property.
Hmm.
So investment property, as you know, is always subject to capital gains tax in Australia as taxable Australian property. But other assets such as shares, crypto, and those sorts of things are considered non-taxable Australian property initially.
Hmm.
And if you don't deem dispose of those when you exit, um, and crystallize any gain or loss that's accrued during that time up until your departure, then they're then deemed to be taxable Australian property going forward, which means that they then get caught by CGT when you actually sell those assets.
Yep.
So that's where you're going to be caught by these sorts of situations. So if you haven't deemed disposed, you're going to be still in the sort of indexation um, realm, which means that if you're non-resident for a day, that's then not applicable to you. So what it does mean though is, because deemed disposal is a bit of a risk,
Yep.
what you're really saying is that I anticipate that my portfolio is going to increase in value such that it's better for me to realize the capital gain now
Mm.
and pay the tax before I've actually sold the investments to be able to come up with the funds.
Yep.
Uh, on the basis that that's the end of my tax on that particular asset, and I can um, rest assured that in the future when I sell that for hopefully a much greater sum,
Mm.
that I'm not going to be taxed further on that item. So
Yep.
that's always a risk, because if the market drops, then you actually are in a worse position.
Yeah.
Um, but so there's always a bit of a guess when you're preparing the tax return for that particular year, because it does need to be made in the year you depart Australia.
Mm. Mm.
Um, and so that's quite key. It doesn't normally, the ATO don't normally allow you to go and adjust that choice because of the benefit of hindsight in the future. So it is kind of key to that. Uh, but an extra factor now as part of that equation is the fact that you can ignore any potential benefit through discount or indexation that might apply. So it just makes the case for deemed disposing that much stronger.
Yeah.
Doesn't mean
Yep.
it's always going to be the case, but I mean, I always question why you would hold on to assets if you don't think they're going to go up in value. Um,
Yeah, I was
but
gonna
it's,
say, like the way I'll frame it with clients is, if you know you're heading abroad for a long time,
mhm.
the probability of success of this asset growing in value is increased the longer you stay overseas and the longer that obviously you're invested in it. So, but short term, one thing you mentioned about, like, if you think you're only going to go overseas for a short period, one, you question whether you're actually going to become a non-resident, but two, yeah, that's going
True.
to be a hard decision to make because we've seen how quickly share markets and market cycles can turn on a dime.
Yeah, that's valid. And often we find practically is when you leave Australia, we're not doing the tax return until sometimes 12 to 18 months after they've left because of
Yep.
the extended lodgement period. So it can give you some valuable insights into whether the market has gone up or down during that time, and gives you some comfort as to what that decision might be worthwhile for you.
Mm.
Uh, it also depends on other factors like whether or not you're going to another country with a double tax agreement and how that then interfaces with the capital gains tax regimes. There's a few
Mm.
countries, specifically like the US and the UK, which actually have some quite unique rules around capital gains and can actually, in some cases, take the decision making requirement away from you by giving you a sort of a better outcome in certain
Hmm.
circumstances. But you
Hmm.
do need to sort of work through that pretty carefully.
Yeah, that's pretty complex advice. I know you've obviously contributed on that a few times over the years, and it's very complex, especially when you're reading through the details of the treaty. Not for the faint-hearted, that one. Well, I mean, given the changes, I guess, do you think a lot of people that are going to be moving overseas, say after 1 July 2027, going to become a non-resident, do you think they'll be seriously looking at their investment properties now and going, shit, I actually might need to sell this now to lock in the benefits I can access before I become a non-resident, compared to a large cohort that ordinarily would have just held on to it?
Mm. It's definitely part of the equation, I think. Like, so
Mm.
if I was framing this as far as a look forward position, is the longer you intend to hold an asset,
Hmm.
after 1st July 2027, the more you need to give this some thought.
Yep.
So if you're not looking to hold on to an asset for a long time after 1st July 2027, then maybe you're not missing out on much of the indexation. But,
Mm.
I think a real sleeper is if someone was to have a property, say they're already overseas as an expat and they're coming back to Australia, they've got an investment property and they arrive in Australia in July or August 2027.
Yep.
So there's at least a day there of non-residency, but
Mm.
they hold that investment property for another 20 years. Um, and depending on what the inflation rate is, I mean, the target inflation band is 2 to 3%, which means that for it to become sort of a comparable 50% discount, it needs to be about between 24 and 36 years.
Mm.
But if inflation was higher at 4 or 5%, then that's only about 15 or so years.
Mm.
So if, depending on what the inflation does over that particular period, if you are looking to hold it for, 10, 15, 20 years, then really you're foregoing, potentially 50% or more reduction in the capital gains tax amount that would be available to other tax residents. So
Mm,
maybe the question is whether or not selling the asset is relevant before 1st July 2027 or shortly after, even if it was repurchasing or moving to
mm-hmm,
a different entity to crystallize a potential gain.
mm-hmm.
It does need to be considered in light of all the things associated with that and the costs
Yep.
associated with doing that as well, like stamp duty and those sorts of things. But
Yeah.
you might want to run through those numbers to see with if there's a business case to actually make some of those adjustments on the sale of those assets or dispose of them if you're thinking about it,
Yep.
um,
Yep.
in
Do you
general.
think, I mean, and just a closing question for you, do you think off the back of this kind of budget, the CGT changes, how we've just obviously unpacked how the new changes impact Australian expats, do you think a lot of Australians that are living overseas will be a bit more mindful of tax structuring when it comes to investing in these kind of properties? Do you think the use of entities will start to rise even for expats?
Mm. It's a good question. I think it comes down to an individual basis. There does, there is, I think, perhaps an argument now for holding investment properties in vehicles other than your individual name, potentially, for example, in a company, which is normally a little bit unheard of.
Yeah,
You
it
do
is. Yeah,
need to
you're right.
make sure it's somewhat compliant. You need to make sure you've got a resident director, which can present a lot of complexity there
Mm,
in making sure that that works. Um, but I can see in certain circumstances this being a very real consideration. When you consider the alternative of non-taxable Australian property when
mm,
you've acquired it as a non-resident and say you dispose of it before you resume tax residency, all of that being capital gains tax exempt
mm.
um, in Australia, um, you would need to be confident of the growth when you're comparing apples with apples to make sure
Yep.
that even on a discounted basis, it disregarding any of this indexation benefit which isn't available to you,
Hmm.
you'd want that to have a return that was going to outperform a capital gains tax-free investment.
Mm.
So
Yep.
I just think without, obviously you're the financial advisor, so you'd be across all of
Oh,
the
the
potential
modeling.
growth scenarios,
I
but
know,
it's
I know. It's it's like you want to call
but
with a client that I was on 2 days ago, and we're talking about the difference between investing in non-tap versus tap
mm,
through an entity and what the final outcome is under a few assumptions. Like I've literally got to do the modeling this afternoon for them, but it's like you're on that call, but that's what we need to weigh up now.
and so just obviously the numbers have to be a lot stronger in the Australian property scenario for that to be equivalent
Yep.
to a tax-free environment there that you've got as a non-resident for non-tap assets.
Yep. That's exactly right. And I think that's a good point there to leave it for today's episode. I think I really want to bring you back on for another couple of episodes. I think there's these little parts of this change in the CGT, the negative gearing. Gosh, I'm concerned about the trust draft legislation that's forthcoming. I don't think I've ever been so angry about a federal budget, to be honest. And I feel like everyone I speak to, including yourself, they're all angry. So we'll see how long that they hold for. But Ben, really appreciate you jumping on today in the hot seat while Brett is offline for the time being. Can't wait to get back on another episode. Thanks for jumping on.
It's a pleasure. Thanks, James. Appreciate it.
Thanks, guys. See you on the next episode.